The statement of owner's equity focuses solely on the equity category. It includes all subcategories of equity and details changes to these categories over a certain period of time. The specifics of the statement depend on the type of ownership. Ownership can take several forms. A business can be organized as a sole proprietor, a partnership, or a corporation. A sole proprietorship is owned by a single individual. A partnership is owned by at least 2 individuals. A corporation is owned by individuals that purchase stock in the company. We will be focusing on corporations. Therefore, our equity category will be called Stockholders' Equity. This is an example of a statement of stockholders' equity. But first, let's think back. Remember the 4 categories of equity? Owner investments, owner distributions, revenues, and expenses. In a corporation, owner investments are called stock. You see a column for stock showing all changes to it throughout the period. Next is a column for retained earnings. What happened to the other 3 equity categories? In a corporation, owner distributions are called dividends. These dividends, along with revenues and expenses, are combined into something called retained earnings. This is the profit or loss that the company has retained or kept. This is a cumulative total over the life of the business. If the company had a $100,000 profit their first year of operations, retained earnings would equal $100,000. If the company had a $20,000 loss their second year of operations, retained earnings would equal $80,000. Dividends are a distribution to owners. Thus, this is taking some of that retained profit and giving it to the owners. Dividends decrease this retained earnings amount as that profit is no longer retained by the business. If, in the second year of operations here, the company paid $10,000 in dividends, retained earnings would then equal $70,000. In this example of stockholders' equity, we have net income of $205,140. This number came from the income statement. We don't need to list the revenues and expenses individually here. That's what the income statement is for. We now take that total from the income statement and use it on this statement of stockholders' equity. This now details the changes in stock and retained earnings over the period and demonstrates how we reached the ending balances of each, as well as the total for stockholders' equity.